Learning objective number 3 is about record sales under a perpetual inventory system. Sales of merchandise. Okay, sales of merchandise. If it's perpetual inventory system, remember I talked about this. You have 2 entries. One to record sales revenue, the other one to record cost of goods sold, right? Remember that egg example, $1, $1.5 sales, and $1 cost, right? So for sales of merchandise under perpetual inventory system, you have to have the 2 entries. Students often they often miss the cost of goods sold entry. They would recognize the sales, okay? Sales tax are not recorded as revenue, okay, because you are collecting the sales tax on behalf of government. It's not your money. You are just collecting it as an agent on behalf of the government. When you collect it, you are liable to file it to CRA, right? So sales tax, when you collect it, is your liability. It's not your revenue. When the freight is as FOB destination, right? That's the time you are, as a seller, pay the shipping cost. If you are you are the seller, right? You sell something. If it's the FOB destination, you are responsible for the shipping. You are paying for the shipping cost, and that cost of freight is your operating expenses. And now you could have sales returns and allowances, okay? So under IFRS, sales are recorded net of estimated return. So what does this mean, right? So if you make $100 sales, and you know there are going to be some sales return, right? If you see the lined up on the Costco, right? So when people buy, they change their mind. They will come to return the items, right? So if you have a sale, let's say in a day, like maybe $10,000, right? For the whole day, let's say Costco have a $10,000 sale. If they estimate 2% will come back, right? 2% of the sales dollars will come back for the day. If they are using IFRS, International Financial Reporting Standard, the sales should be recorded net of estimated return. That means they should not record it as 10,000. Instead, they should consider the net, right? If they estimate 2% of sales return, they should only record 98% of the sales, okay? So they should record 9,800 instead of 10,000. Okay, so the idea is you don't want to recognize the revenue for the anticipated sales return. If you know that percentage of sales will be returned, right? What's the point to recognize the revenue? So that's the point here, right? A refund liability account is used to track expected sales return and allowances. Okay, so if you expected 2%, right? And then you want set up, that liability as 2%. So for the asset account, estimated inventory return, how are we doing with time? Okay, I have 3 minutes. So as asset account, the estimated inventory return is used to record the cost of goods expected to be returned. So remember when you do the sales transaction, right? you have two entries, one to record sales, right? The other one is the cost of goods sold and the inventory. Okay, so and because of this uncertainty, right, you would have, these two account. Okay, a liability account and an asset account to offset each other, right? So the refund liability and the estimated inventory return, that are two offsetting account, right? Those two accounts will track expected sales returns and allowances. Okay, so do I have enough time to go through this? Probably not. So I will leave the last slide to the next lecture. Okay, this chapter has a lot of information, right? So it's important you're going to review this, right? Work on some questions. So if you don't have any question, the class is dismissed. Okay, if you have any questions, please stay.